most of the inflation we've seen was from large monetized fiscal stimulus, very large deficit spending. And so as they try, and the Fed has no tools to deal with that. If the government just gives everyone $10,000 to spend, either the treasury market's going to break or the Fed's going to monetize it and it's going to be inflationary.
What's up, Sats fans? Welcome to another episode of Swan Signal. I'm your host, Sam Callahan. I'm the lead analyst at Swan Bitcoin.
If you care about your financial future, you need to check out a couple of our offerings, including Swan IRA and Swan Private. Swan Private is our white glove concierge service where you get a trusted partner on your Bitcoin journey. We offer all kinds of education and research projects, as well as exclusive events to our Swan Private customers. Check it out today at swan.com/private. Also, Swan IRA. Swan IRA is the best way to gain exposure to real Bitcoin in a tax-advantaged account, like a traditional IRA, a Roth IRA, or rolling over your 401k. So if that interests you, check it out at swan.com/IRA today.
And we have the wonderful Lyn Alden of Lyn Alden Investment Strategies with us. She really needs no introduction. She comes on the show quite often to share her views on macro and Bitcoin. So welcome, Lyn. I guess early happy 4th of July. And thanks for being here.
You as well, and thanks for having me back. Always happy to be here.
Yeah, so there's so much to talk about in the markets right now. And you've written some recent pieces that I want to dig into. But first, I just want to get your general reactions to the equity market specifically. Year to date, we have the Nasdaq off to one of its hottest starts ever. And it's been really concentrated to almost 7 stocks. I think 7 stocks make up 85% of the S&P 500 gains so far this year. And so what do you think of this equity rally in general? What do you think is driving it? And how do you feel about how narrow it's been?
So far, I think the biggest correlate has been liquidity. There's different ways to measure liquidity, but back in say the first half of 2022, which was terrible for most assets in general, you had both the Fed and the Treasury pulling liquidity out of the financial system, and then starting late last year, you had the Treasury putting liquidity back in, basically reducing their cash account, which is like this void of cash that's not being used, and when they're diminishing it, they're basically putting it back into the market. And they had to go lower than they expected because of the debt ceiling. So they had to drive it all the way down to roughly zero at the start of June. And so for that like say roughly 9-month period, 8-month period, you had the Treasury offsetting the Fed. And so you started to get flat and even slightly higher liquidity conditions when you also include things like Fed liquidity injections to the banking issues in March. And so you started, if you map out the stock market relative liquidity, it follows it pretty closely. In recent months, I think things have gotten a little bit euphoric. The stock market's kind of gotten ahead of what you'd expect based on liquidity alone. Obviously, it's not the only variable. There's other things to consider. But the enthusiasm around AI and tech and things that are generally perceived to be recession resistant and that benefit from the Fed kind of getting to the top of their rate hiking cycle have, in my opinion, been somewhat overbought. There's a lot of indicators that retail type of investors are kind of aping into it to some extent. And it's hard to justify some of these equity valuations when you compare it to, say, a 5% discount rate. Many of them are trading at valuations that you would normally see before, back when the alternative was like 0, 1, 2% interest rates. And so I am concerned around the narrow scope of the rally and this final multi-month move we've seen in some of these assets. But I think other parts of the market are trading reasonably. They're doing what we'd expect in the face of kind of neutral liquidity conditions. And then I think, as we'll talk about later, there's really big forces that are stimulating the economy as well. Very large fiscal deficits that are kind of, again, it's sort of a case where the Treasury in some cases is offsetting some of what the Fed's doing. And some of that, I think, is manifesting in the stock market.
Yeah, you brought up liquidity being kind of one of the key drivers of this rally of not just equities, but Bitcoin. Bitcoin's described as a liquidity sponge a lot of times. It's a liquidity driven asset. And you talked about how there's these dynamics between the Treasury General account getting drained down, kind of offsetting some of this quantitative tightening. And now there's a really different dynamic going on with them refilling the Treasury General account. So we had this whole debt ceiling drama and it got resolved. But then there was a lot of concerns over how that would actually affect liquidity. And you kind of pointed to some of these dynamics. What do you think about it now, and how has it played out since the debt ceiling was resolved and they started refilling the Treasury General account? How has it impacted liquidity, or how are you seeing things?
So far, it's been relatively neutral because the Treasury essentially had to blink. So when we saw this liquidity suck coming, so basically the Treasury was transitioning to a point where instead of drawing down, its cash account is going to start refilling it, as you pointed out, and that all else equal would be net negative for liquidity, assuming the Fed keeps doing what they're doing. Um, the only ways around that would be that the Fed could pivot and assist with some of that Treasury issuance by monetizing it, and the other option is that there's the over $2 trillion in reverse repos, which is basically another dead pool of capital. And mostly what that represents is spillover for T-bills. So there's more demand for T-bills, specifically like the short duration part of the debt curve, than there is for them. And so one of the risks is that basically you'd have so much demand for T-bills that you'd push the yield below the Fed's interest rate target, below the lower bound of it. And so one of the things they do to try to maintain their interest rate target is they have this reverse repo facility that is like a spillover. So if there's extra demand, they can instead go in there. And the market has made, over, I think the peak was like over 2.2 trillion, maybe higher usage of that facility. And long duration treasuries, if they issue a lot of long duration treasuries, it won't impact that facility. That'll come out of like bank reserves. Whereas if they specifically issue a lot of T bills, that can suck some liquidity back out of that reverse repo facility and finance it that way, which is basically neutral for liquidity. They're not sucking out of the banking system; they're sucking out of this like void of reverse repos, which is mostly money markets. And from the money market perspective, you don't really care if you're holding T bills or reverse repos; they're kind of the same thing from a end user perspective. Now, what makes it interesting is that the right now, because the yield curve's inverted, the T-bills are the most expensive part of the curve to finance on, right? So when the Treasury decides what types of instruments it's going to issue to finance its deficits, it has a variety of different things to consider. How's it going to get the best deal for the government? Like, what's the lowest yield with which it can finance this, as well as taking into account things like liquidity and other problems like that. And so what's interesting is that they made the decision to finance it almost entirely with T-bills.
Hmm.
There's a very high ratio of T-bills that they're using. So they're basically sacrificing cost. So they're financing on the most expensive part of the curve in order to be beneficial or at least less harmful for liquidity than if they tried to say issue a bunch of 10 years, like a flood of 10-year
Yeah.
treasury notes. And so far, they've been effective at pulling a good chunk out of reverse repos. I think we have to keep watching it because so what makes the data complicated is that mid June had quarterly tax payments that disrupts the data for a period of time. But so far, the signs are pointing towards when you look at their issuance schedule and towards what's been happening, they've been drawing most of their issuance out of reverse repos. And as long as they're willing and able to do that, so as long as they want to keep issuing on the short, expensive part of the curve, basically just kind of reducing the government's average debt duration, then they have basically almost $2 trillion or $1.9 trillion to kind of keep pulling from without sucking out of banks. So I think that's kind of the main thing that they're going to probably try to do their best to keep drawing down, because that delays when the Fed, for example, has to do more quantitative easing, and that kind of pushes away at least some of these more serious liquidity issues.
Yeah, so the Fed basically issued at a shorter duration, but it was more expensive for them, so they had to be concerned about these liquidity issues. I mean, it makes a lot of sense to me why they would go that way if they were concerned about it draining bank reserves and taking liquidity out of the system. Much more better if it comes from this reverse repo facility. But are you surprised at the money market funds that they were attracted so much to go for these two bills? Because the spread between what they're earning in the reverse repo facility and the T-bills, it's not like significant. And there's some talk about like how hard would it be to get those outflows to happen when they issue the T-bills. So are you surprised at how much it's kind of correlated with the reverse repo facility in terms of that's getting drained down at almost really close to how much is being issued? I mean, it's basically seems like it's all coming from the reverse repo facility. So are you surprised at how this has played out?
So I'm not too surprised because the T-bill rate is slightly higher.
Yeah.
than the reverse repo rate, and also once they took default risk off the table, um, that basically made them more attractive for the next handful of years to these money markets. So
Hmm.
that's not too surprising that they're willing to soak them up. The thing I wasn't sure about is how closely the Treasury is watching liquidity issue. There's always a risk that they underestimate. A lot of these, Secretary Yellen is a labor economist. She's not like she doesn't have a background in securities markets, for example. And so I think there were concerns regarding, does the Treasury fully know kind of the magnitude of some of the liquidity limitations out there? Are they going to try to ham fist a bunch of like long duration securities through and cause a problem, or are they going to be more tactfully about it? And I think so far they've made all the decisions that they need to. In order to navigate this with kind of the minimal disruption to liquidity. So I think that's a little bit surprising that there's a kind of a spectrum for how they could handle this. And so far they've handled it, about as smoothly as you
Yeah.
can handle it. Um, they get guidance from banks. I mean, they have councils that recommend what would be good for the market. I think they've paid very close attention to liquidity. They also, to Yellen's credit, back when it was September of 2022, back when kind of the market was at its bottom, dollar index was at its height, liquidity was really bad. Like that was back when the treasury market was getting really illiquid,
Yeah.
and the gilt market like broke. Yellen was talking about liquidity. Basically, she was talking about concerns there. That's also when you had the Bank of Japan come in and intervene to stop the yen dollar pair from going over like 150 or so. It was one of the biggest interventions in decades from them. And so there were a number of clear, like, they were aware that there were issues. And so far, I think they've generally tried to navigate them. You also see that Yellen and others are talking about how in 2024 the Treasury plans on doing buyback program, which is it's not quite. It is what it sounds like, but it's not quite what it sounds like. Basically, that they would have operations to basically be able to buy back existing securities and replace them with newer securities, which in theory kind of, you shouldn't have to do that with what is supposed to be the most liquid market in the world. It's kind of a sign of stress. But basically, when you look at treasury issuance, there's the existing amount of treasury outstanding. There's kind of two types. There's on the run and off the run. So on the run are like newly issued ones. Off the run are kind of like, like let's say you have a 10-year treasury with 9 years left, right? It's kind of a,
Yeah.
a weirder security. Now normally that shouldn't be an issue, but in a market with kind of liquidity problems, those off the run securities are kind of non-standard, and they're the ones that have the more severe liquidity issues, so that they'll have the option of like buy back securities that are having liquidity problems and then issue more. And they can also, that allows them to potentially shape the duration a little bit different. So they're going to have kind of tools in the years ahead to try to deal with these liquidity problems, and they seem to prioritize more than I would have guessed.
Hmm. Well, one of the tools that the Fed has is interest rates, and that's been the primary tool to fight inflation in the past. You wrote an excellent piece called Fiscal Dominance, and you really went into detail about why maybe that tool isn't going to be effective given the inflation that we have today. And so I think it would be great just to give an overview of why you think that is the case in terms of why the Fed's interest rate policies potentially are going to be ineffective here.
Right. And to answer that question, we have to go back to analyze the question of why interest rates are believed to be effective as an inflation fighting tool. Right. Now, in a free market, the market would set interest rates, but we don't really have a free market in money. The central bank sets short term interest rates. And in some cases, could even affect longer term interest rates. Um, and so basically, when you have money creation, right? So most inflation is tied to basically two things: money creation or supply side limitations. And so you don't have a perfect correlation between inflation and money creation, but you have a significant kind of correlation over, say, a 5-year period. And when you look at the sources of money creation, there are two main pathways. So one is bank lending. As fractional reserve banking system lends more money out, creates more loans, they create more deposits, and you get that increase in broad money, more IOUs chasing a similar amount of goods and services, and you can get price inflation. The other one is that if the government runs very large fiscal deficits that are financed either by the banking system or by the Fed or by other large pools of capital that are just kind of sitting around there, um, that is spending more and more money into the economy, kind of creating new money with that pathway. And so the tool of using interest rates to try to slow down inflation is based on trying to slow down bank loan growth. So
Mm.
trying to slow down the rate of new lending. Um, and that works pretty well when that's the source of inflation. So, for example, the main example where that was successful is the 1970s because that was the peak U.S. demographics in terms of credit formation because you had the baby boomer generation that was born starting in the late 40s, early 50s. As they started turning 25, 30 in the 70s and then eventually into the 80s, that's when they go buy a house, and the house is like the biggest source of new debt generation, right? So the majority of household leverage is mortgage leverage, and so you had a big boom in bank lending, which is mostly demographics driven, and then of course that was combined with the fact that in 1970 U.S. oil production peaked after like a century of steady increases. We just our conventional oil production peaked, and we became more reliant on imports, which of course opened us up to all sorts of geopolitical bottlenecks and problems there. And so the combination of having some real supply side constraints with a more rapid rate of loan and money creation was inflationary. And one of the tools that they did was jack interest rate up super high to try to slow down that rate of loan creation. It also had a side effect of, especially back then, Latin American countries had a lot of dollar denominated debt. And by strengthening the dollar with that policy, they were just crushed. They were like defaulted, their
Yep.
currencies were wrecked. They went into like a depression where they could consume less oil, which left more oil for us. It's kind of brutal geopolitics. That's usually not a factor that people remember about the Volcker era, that we basically had to throw someone else under the bus in order to free up the oil market.
Mm.
But basically, higher interest rates are an effective tool at slowing down bank lending, which makes sense when inflation is primarily being driven by bank lending. The problem is that if you have inflation primarily driven by large federal debts and deficits, um, the problem is not really from bank lending, right? So, for example, in this whole, say, the past 5 years, bank lending has been normal. We've not had excessive bank lending. It's not as though there's just this boom in loan creation. There are periods where it was low. There are periods where it was kind of on its upper bound, but nothing like the 70s. Most of the inflation we've seen was from large monetized fiscal stimulus, very large deficit spending. And so as they try, and the Fed has no tools to deal with that. If the government just gives everyone $10,000 to spend, either the treasury market's going to break or the Fed's going to monetize it and it's going to be inflationary, right? So
Mm.
in that situation, they're stuck with this thing where they're trying to raise rates to deal with inflation, even though loan creation was not the primary driver, right? But they don't really know what else to do because they say, well, we can't just do nothing. It's our job to do something. So we're going to suppress loan creation kind of below the baseline to try to offset the fact that the public sector is kind of pouring money into the economy. So that works for a period of time. The problem is that if you get over 100% debt to GDP, and especially in Japan's case, like let's say over 200% debt to GDP, the problem is that every time you raise interest rates, you massively increase the deficit. So more ironically, more money pours into the economy the higher you raise interest rates. And to quantify, I mean, with Japan being an extreme example, you know, their uh, their rate of new loan creation in a given year might be 2.5 or 3%. Whereas, their deficits are like 5, 6, 7% of GDP. But then more specifically, if you have 250% debt to GDP like they do, every 1% increase in the weighted average interest rate of that public debt is 2.5% of GDP of basically new money creation, which is like the amount of like almost all loan creation that year. And so they're in a situation where, ironically, interest rates, if you raise them, could have the unintuitive outcome of being inflationary. And the United States is not probably there quite yet, but we're on the point where deficits are already bigger as a source of money creation than loans in most years. And it's not necessarily a one-to-one correlation because generally interest expense has a lower propensity to be spent into the economy than loan creation. But in general, it's kind of now these two forces are competing with each other. And so interest rates are in many ways no longer the best policy tool for this environment. Generally, if they wanted to slow down inflation, they'd have to slow down fiscal deficits. They'd have to kind of pivot to a period of financial austerity. And right now, of course, that's not on the table. And
Yeah.
so the challenge is that to the extent that they want to slow down inflation, they have to basically put the economy into recession. They say, well, if we kill the private sector enough, maybe we can offset the public sector inflation. But that's not really what people want when they want, low inflation, right? If it's like, when people say they want low inflation, what they generally want is disinflationary growth. And so if you
Mm.
put the economy into a recession, but don't actually address the core problem, which is, 5, 6, 7, 8%, deficits as a percentage of GDP, kind of the ongoing problem's still there.
Gotcha. So that they spike interest rates to 5%. And in 2022, we saw like interest rate sensitive sectors like housing and unprofitable tech companies really get hit hard. And it kind of culminated into this like banking crisis. Some people would say, though, banking lending standards, I think 46% say they've tightened lending standards, according to the last senior loan officer opinion survey. We're seeing a lot of struggling banks, the regional banks. We have the bank term funding program. And so when you look at that and you're trying to compare like how these things, like a tug of war between the Fed interest rate policies trying to crush demand and loan creation at the banking level, but then you also have the public sector and the spending that's going on, the fiscal deficits. How do you measure like how they equate to each other and which one's winning? Because it seemed like in 2022, the interest rate policies were winning, and now it seems like this fiscal is starting to have more inflationary pressures come in now. Like, what are you looking at when you kind of measure the two?
So one of the things I look at is the sheer dollar volume of fiscal deficits compared to year over year loans, right? So how much more bank loans are outstanding this year compared to a year ago, versus how much bigger is the public sector debt, compared to a year ago, taking into account TGA, fluctuations,
Mhm.
things like that, how much is actually spent in the economy. And so, for example, back in the 70s and the 60s, loan creation was much larger than the fiscal deficit. So the majority of new money came from, fractional reserve banks multiplying it. Whereas in the current era, fiscal deficits are a larger absolute number than the year-over-year absolute number of loan creation. And so that's number one, is just kind of looking at absolute magnitudes. But then you have to adjust both of them for how inflationary they tend to be, right? So on average, I use this example in the article. I mean, if you gave out $1 trillion to like the top 10 or top 100 richest people in the country, like all the Warren Buffetts of the world, they wouldn't go out and buy more with it. They already can buy anything they want, and so
Yeah.
any money you give them is going to go into financial assets. And so you might increase the value of the stock market, but you're not going to probably increase the price of hamburgers, because these 100 people are not going to buy more hamburgers. Whereas if you took the same trillion and you gave 5,000 or 10,000 each to the bottom 100 million or 200 million people, they're going to go out and buy stuff with it, because their spending is constrained by their income. And so they're gonna pay off some debts, or they're also gonna spend more. It depends on the individual, but a lot of that will get spent pretty readily into consumer types of things and drive up inflation. And so interest expense is challenging somewhat to measure, but on average, it does tend to go a little bit more towards the upper end of the spectrum, right? So it's not the
Yeah.
same. It's not going to have the same inflationary impact as stimulus checks, child care tax credits, that sort of thing. It's going to go to fairly wealthy retirees. It's going to go to bond funds. It's going to go to banks. It's going to go to insurance companies. Um, it's going to go to some pension funds. So that's, the ones that will have a tendency to spend it are people who might have otherwise lost their pensions that won't, um, wealthy retirees that have more income coming into their portfolios than they did before. So you do have a greater propensity to spend, but it's lower than what you get in other types of stimulus. You also see about a quarter of it just goes out of the country, but because about a quarter of Treasury debt is owned by the foreign sector, and so some of that can go out elsewhere. Now that can still be inflationary because, for example, that could be used to buy commodities and potentially drive up global commodity prices. Um, but it's not this like quick acting thing. And so in 2022, we saw that the pressure on the private sector was bigger than what we were seeing from the public sector. So far in 2023, it's more of a tug of war. You still see disinflation happening. You still see recession indicators mounting. But these things are coming down slower than a lot of people thought, and I think a lot of that is because you're basically running $2 trillion deficits into the economy. It's almost like you're pre-stimulating. It's not the most
Mm.
targeted form of stimulus, but you're still in a way pre-stimulating before you even have a recession, which kind of drags things out, makes things more stagflationary rather than you know a big deflationary bust type of thing.
Yeah, so I mean, basically to sum it up, when we have debt to GDP get to these levels, they are now like around 120%. When the Fed raises interest rate, it just makes the interest expense that much greater. I mean, you said that I think you said if it increases 1%, it'd be the equivalent of adding 10 NASA's, I think you said, right? Which is
Yeah.
just insane. So that's why it could be positively correlated with inflation. And that can be kind of a backwards thinking for people. And I don't know if you saw this, but the Biz came out with an annual report. And I thought it was fascinating because they brought this up. They said easy monetary policy can induce the government to build up more debt, and expansionary fiscal policy can make it harder for monetary policy to be as tight as necessary. So the two can reinforce themselves. It came off as like a warning to these central banks about the risk of further inflation becoming entrenched, as well as declining growth, this like stagflationary environment. But when you look at this, it just doesn't seem like these governments or politicians understand that the spending is actually contributing to this inflation. It seems like they blame it on every single other thing. And so the odds of them going or using the tools that we need, which is like austerity, like you brought up, seem extremely no or low. No.
Yeah, I think it's very low, especially I mean, it depends. It's like a country by country basis.
Yeah.
Um, but especially for like the United States and Japan and countries like this, generally policymakers are not going to look at interest rates and say, well, because interest rates are higher, we're going to spend less. It's just not how they work. And so I think that is it's probably going to be very difficult to address. Another challenging thing, let's use the United States as an example. The vast majority of the federal budget is military, Social Security, Medicare. Um, and within military, you can also add things like Homeland Security and veterans benefits, things like that. So collectively, these are all very popular programs, right? So the people that tend to vote are older, and they're not, any candidate that says, "Hey, we're going to slash Social Security and Medicare," I mean, you're good luck
Yeah.
getting elected, and then actually getting a coalition to agree with that. We've even seen in the Republican Party there's somewhat of a split there. Trump, for example, is a he wants to preserve those, whereas there is still a segment of the Republican Party that's more of the fiscal hawk type, kind of the back in the day was like the Paul Ryan type where they do want to trim some of those. But in general, in modern years, the Trump wing of the Republican Party is dominant. So whether or not you look at the Democrat side or the Republican side, generally cutting these programs is like a third rail. Um, and yeah, that's where the most of it is coming from. Another challenge is that once you get to this height of debt to GDP, and once your economy is this financialized, you can fall into a trap where if you actually try to cut the deficit, it can cut the GDP by just as much, and so your deficit as a percentage of GDP is actually still just as big.
Yeah.
So austerity works when you're starting from a position of strength, um, but when you're already this financialized and this indebted, um, there's not that many ways out. It's kind of like if you just took the finances of the government and said, okay, here's this unprofitable corporation with it's like debt to sales multiple that's like super high. Debt to income's off the charts because income's negative. And it's like, what is the chance they're not going to default? And it's almost zero. They're going to default. Of course, now if you give them a money printer, they're not going to default. But I think that's the problem that they find themselves in is that in addition to having to pivot towards austerity, they're already in this trap, and some of the debt just has to be essentially restructured, defaulted on, inflated away. And of course, nobody, that's not a decision that anyone's going to actively make, but it's just going to kind of, I think, be made for them by the market as we kind of grind through this.
Right. So, I mean, it seems like, and I heard you say this, your base case is actually a more mild stagflationary recession instead of this like really, really hard landing. And I was wondering if you can maybe go into why you think it's going to be more mild, more drawn out. Maybe is it these fiscal deficits, or are there other reasons why you think that's the case?
Yeah, mainly the deficits. Now, I'm still watching data to see to what extent I might revise that, but the current data I think point towards this kind of more stagflationary type of environment because, you know, especially in the modern day when people think of recessions, we've been so accustomed to think of 2008 and then like 2020 COVID, like these like huge deflationary just collapses.
Yeah.
Whereas you look to the prior one, let's say after the dot com bubble, for example, that was a mild recession. And I think the one now, it's not the same as back then because a lot of things were in our favor back then. But essentially, when you go back to the thing, whereas we're running 8% of GDP deficits when unemployment is below 4%. We're running $2 trillion deficits before there's even a recession. And if we get a recession, those will widen because tax revenue will stagnate. Um, and so, you know, it's just you absolutely can have a recession when you're doing that, but it changes the scope of the recession. And one comparison is kind of to look at what happens in emerging markets during recessions, right? It's I mean, there's different types of them, but a lot of times what ends up happening is that, nominal numbers still go up. It's just that, you have kind of sticky inflation because usually their currency is not doing great. So usually, so for example, their stock market is often going up in local currency terms during recession. But of course, it's doing poorly in dollar terms or gold terms, kind of a harder money comparison. But usually you have that environment where because their currency is having a problem, because they're running big deficits, it's just a very different type of recession, which is it's not really a better or worse, it's just different. And so, especially with labor shortages and a $2 trillion annualized deficit, I think any recession we'd see in this environment is likely to be somewhat different than the big deflationary bust that we're used to. Potentially another way of looking at that is you can certainly have segments that are having that kind of catastrophic deflationary bust. I mean, I don't think too many people are bullish about office real estate, for example. With interest rates have gone what they do, and with their occupancy rates what they are, there are certain parts of the economy that I wouldn't touch with a 10-foot pole. But on the other hand, that's offset by basically things that are getting stimulated, right? So we have like record numbers of air travelers right now, even as we have, a lot of things point to recession. So if you look at gross national income, it says recession. If you look at ISM Manufacturing Purchasing Managers Index, that says recession. So a lot of different indicators suggest either recession or near recession, basically like stall speed. On the other hand, you're pouring money into the travel sector and you're pouring money into all these other things, you kind of balance it out, or at least, on an aggregate level, you somewhat balance it out, or at least you soften the blow. Of course, that comes with the cost of inflation does not come down as quickly as people think. And I think the biggest problem, when I analyze the topic of inflation, it's not whether or not they can get it down in the near term. And if you cause a recession, you can get it down in the near term, most likely. And that's so far what we've been seeing. A reduction in economic activity, reduction in year-over-year CPI. My concern is that the next time they want to have a period of growth, so the next time they want to have rising PMIs, the next time they want to have rising year-over-year GDP levels and things like that, there's a very high chance that's going to come with some degree of inflation again because the core problems are not actually being addressed. So the rates and things like that, they're not actually addressing the core problem, which is the combination of large fiscal deficits and then any sort of like supply side constraints we run into, let's say energy, for example.
Yeah, I mean, so you brought up the service sector. I mean, people have called it like revenge spending. Everyone was locked up during the pandemic, and now everyone's spending money like crazy on things like concerts, on things like travel, hotels. And so you're seeing that part of the CPI remain pretty sticky. And you brought up energy, and I feel like energy or oil is like the X factor in all of this. And I'd love to get your thoughts on where you see the price of oil going maybe in the next 6 to 12 months, because I think if we see oil start to rip towards 100, that's obviously going to be an inflationary pressure and make it difficult for the Fed to achieve its its goals, its targets?
Yeah, so far China had a slower reopening than a number of people thought. Their economy is kind of coming out of their lockdowns pretty sluggishly, in part because their fiscal policy at the moment is kind of the opposite of ours. They're not running big deficits. They're trying to be somewhat more austere. They've got other, they have problems in the real estate sector. They're doing a little bit of loosening with their monetary policy, but they're not really resorting to fiscal yet. And so China's coming out of this pretty slow. Also, Europe's partially deindustrializing because they just don't have the energy infrastructure to grow their industrial base the way they used to. Um, and so we have kind of this like decent supply demand mix for oil at the moment. There's pariah states that are still able to get their oil to market, so the supply side's been decent and demand's been kind of muted. It's not been collapsing, but it's not been booming either. Or more specifically, it's booming in some areas, it's kind of pulling back in others. I think the challenge is that when you look at it a little bit further, so most of the growth in oil we've seen over the past decade was from U.S. shale. Um, and that is, it requires constant drilling. You get oil supply online quicker, but if you stop drilling, it starts declining a lot quicker as well. It's not like an offshore oil project where you're going to get this like long, reliable period of oil with a big upfront cost. It's more like this rapid thing onshore. And the problem is that in recent months, drilling has kind of rolled over, and production is not rolled over yet, but that comes with a lag. And of course, depending on how much drilling rolls over, production could kind of flatline for a period of time. It could actually dip somewhat. But I think the point is that supply side just does not look super healthy. So, in the run up to the global financial crisis, so the whole like, most of the 2000s decade, you had a commodity bull market, but you also had a lot of new supply come online. There's a lot of drilling and a lot of capex and things like that. Whereas in this kind of recent bull market, all the participants have faded it. So all the oil companies, that when oil was spiking to 120, they're like, no, no, we're going to be disciplined. We're going to, strengthen our balance sheets. We're going to return capital to shareholders. We're not just going to keep plowing it back into the ground. And so that's kind of starting to materialize now, which is we never really brought a lot of supply online. We also, the United States drew down a strategic petroleum reserve. That's actually another way we kind of were emerging market like. So, what does an emerging market do when they have a problem with inflation? Well, one of the things they can do is sell some of their foreign exchange reserves and try to shore up their currency. The United States kind of treated its oil like that. We drew down, not FX reserves, but oil reserves, um, to kind of helps fix the supply demand balance what was happening, and support that inflation reduction. The problem is that can't be repeated again, at least not at that magnitude. And so when you look around and say, well, now there's not really like another SPR about to flood the market. Shale is, it's the production's kind of how it was a few years ago. It's recovered somewhat, but again, you have drilling rolling over. And so I think when you look out a few years, the oil market does look pretty tight. Now, when you look at any sort of 6 month period, that's I think more of a demand question, right? So you have to ask questions like, is China going to do some fiscal policy, or are they going to kind of keep in this like stall speed that they're on? The United States, are we going to enter or be confirmed to be in an outright recession? Or are we going to, or are these like fiscal deficits going to kind of keep us at stall speed, for example? Um, One thing, people assume that oil demand collapses during recessions, but in general, it actually reduces very little, if at all. So, global energy consumption has only gone down in like 5 years out of the past like 50 years. And so, for example, in the first 3 years, the 1980s, right after the Volcker, super high interest rates, they had 3 years of declining global energy consumption, in large part because of Latin America being kind of taken out of the market. You also saw it in 2009, so that was a bad enough recession to cause like a global reduction in energy consumption. And then, of course, you saw it in 2020 because of the lockdowns. That was the biggest year-over-year reduction. But outside of those 5 years, including some other recessionary years, you don't see a reduction in global energy consumption, or to the extent that we might see one, it's generally very small. And so while oil demand softens. It's not as though it collapses in a normal economic environment. So I think going forward, I'm kind of neutral until we get more clarity about, are we going to enter an outright recession? Are we going to get higher unemployment? Are we going to get, fewer people traveling, fewer people, flying, things like that? But I think once you look past that period, until we have a big capex cycle, I think energy is going to be kind of sticky to the upside. That, to the extent that we get down briefly, it's going to want to come back up because there's just not a ton of supply out there. And so I think that's still kind of a story to be aware of in the latter half of the 2020s. Any further like inflationary waves we have, I think will probably partially be energy tied.
Makes a lot of sense. I want to pivot a little bit to Bitcoin. Obviously, Bitcoin's off to a good start this year. But you sent out a tweet and you said, I don't know what it will do over the next year, but the asset I am most interested over the next decade remains Bitcoin. And so when you're looking out maybe 2 years, 5 years, 10 years, you're still pretty bullish on Bitcoin. And I just wanted to hear, Lyn Alden's bullish take for Bitcoin. Like why do you think it's so interesting? And when you look out and you put it against this entire macroeconomic backdrop, why Bitcoin?
So I think ultimately it solves a lot of problems with money. I mean, one of the things I've been working on over the past year is a book on money, and it's really a book about the technology of money over time. And a big problem that humanity has had for like literally a century and a half is that we figured out how to speed up our transactions. So ever since we invented the telegraph and then started laying the cables under bodies of water. So the UK and France were connected in like the 1850s. And then by the late 1860s, you got United States and Europe, cross-Atlantic cables. And then from there, we got it across the Pacific. And so you could send information. That was the first time we could send information really at the speed of light. Prior to that, information had to move at the speed of people. Whereas now we could send information, within seconds and minutes, and so we could update ledgers around the world, instantaneously. And of course, we added the telephone, we added the internet, e-commerce, all that. Whereas settlements were still slow. And so even during the classical gold standard, which is known as a good period of monetary history, it was ultimately unstable. There were way more gold IOUs trading rapidly around there compared to the amount of gold in the system, in large part because of how efficient transactions and netting were compared to the underlying metal. Um, and then you had the Bretton Woods system that broke. It's often talked about how it was formed in 1944, but that was just the conference. It didn't really go into full effect until like 1958, and then within like 13 years it broke.
Yeah.
Um, it's like basically all these ways, all these like bad systems try to close that gap between transactions and settlements. And so what I think Bitcoin represents is the first time where you have settlements that move at the speed of light or almost the speed of light. And so that's the first time where that fundamental mismatch is solved. Um, and it's now, it's been a while. I mean, at first when I saw Bitcoin, like, more than a decade ago, I was like, that's neat, but, who knows? I don't know if that was going to be the winner. I don't know what this market's going to look like. But as Bitcoin has proved itself, as it's been shown to be truly decentralized, as it's gotten through various conflicts, and as it's retained so much market share, I think it's increasingly clear that just Bitcoin is a key solution to money. And the world's been stuck in this like local maximum, right? So obviously, the invention of telecommunication systems is a good thing, but it did leave us with a situation where gold and silver are not effective money. Central banks have a monopoly on practically on money. There's 160 different fiat currencies approximately, and each one is like a monopoly in its own area. But then, other than the top, say, five, there's very limited salability anywhere else in the world for that country's currency. I have Egyptian pounds in the drawer next to me, and good. I like around here in New Jersey. Like, good luck for me trying to like have someone take them off my hands for me. I have Norwegian currency, which is obviously a stronger currency, but even there, the saleability is terrible here. It's,
Yeah.
it's really only dollars and euros and a couple others that have any sort of reasonable saleability outside of their own countries, and so we've been kind of stuck in this like barter system, with the invention of fiat currencies. And gold and silver just been too slow to ever reassert themselves and say, hey, here's we don't have to use these crappy currencies. We can use gold and silver. The problem is they're just too slow. And so I'm bullish on Bitcoin because I think it does truly solve the problem. It's held up against all sorts of different macro environments, all sorts of different technical challenges. Um, and there's so much building on it happening, right? They say building happens in bear markets. And I've been watching that closely. I mean, I'm involved somewhat in venture, so I get to see what founders are building. And it's just super exciting. I mean, one of the things I'm most excited about is the stuff going on with Fedi and Fediment,
Yeah.
and that whole ecosystem. But just beyond that, there's just so many things that are being built, and I think that the world's just not ready for it yet. And I think that that'll materialize in the years ahead. And of course, any given 6 month period, Bitcoin's price is going to be tied to liquidity. So a handful of choices between Yellen and Powell and a few others can probably move the price pretty substantially. So I don't really try to make 6 month predictions, but I think the floor is probably in, and I think we're headed higher in the years ahead.
Yeah, the building in the bear market has been extraordinary. I mean, we just had Obi on the show couple shows ago, and also bullish on Fedi and different custody solutions, mini script. Like, I mean, the list goes on and on. Lightning, obviously, and so it's been really interesting to watch that in the bear market. It reminds me of the 2018 bear market because the price was kind of disconnected to what I was seeing on the ground in terms of the growing ecosystem, and I get the same feeling today. But one of the interesting things about Bitcoin is that it's such a tiny asset. I mean, when you look at it in the grand scheme of things, compared to other asset classes, it's so small, which means there's a lot of opportunity. And this past week, we saw a lot of institutional interests. We had the BlackRock filing a couple of weeks ago. We had large European banks come in and try to get custody of digital assets, like apply to licenses and things like that. So how do what's your take about that? Because we had about 26 trillion of assets under management with all these institutions who all had kind of bullish developments when it comes to Bitcoin. Seems like they're entering the fray finally, maybe capitulating that Bitcoin is here to stay. What's your overall take about these ETFs as well as those other developments?
Yeah, so I mean, there's depending on what measurement you use, there's hundreds of trillions of dollars of global assets, and Bitcoin is hundreds of billions. So it's a fraction of 1%. Um, and when you look at the total addressable market of Bitcoin, there's obviously a big range. It's hard to say exactly what that market is, but it's not far fetched to say most entities would want to have some handful percentage of their assets in this portable, finite, self custodial asset, liquid. Um, and so another bullish thing about it is that in some ways, certain entities can't even adopt it until it gets bigger, right? So when daily trading volume was in the millions, a billionaire would have trouble getting in and out of it without moving the price. There's just not enough liquidity for them to comfortably uh, enter and exit it in size, other than just dabbling. Similar today, there's billions of dollars of liquidity, but $1 trillion pool of capital has to be careful about moving the market, how much they can enter or exit, and things like that. And so I think as you see more and more, I don't like the word regulatory clarity, but it comes up a lot. I mean, basically, once they see, okay, Bitcoin is different than some of the other assets, um, the government's not going to ban it, or it'd be silly if they did. You start to see different pools of capital to say, okay, it's normal to have a non-zero amount in this asset. So 6 years ago, BlackRock called it like an index for money laundering, and now they're filing ETF to hold it, right? So they've done a complete U-turn, um, on how they perceive the asset, um, largely due to market demand, ongoing adoption, ongoing education about the space. I think to some extent, it's I I would always like to see, like, I'm always more interested in developing country adoption of Bitcoin
Sure.
more than I am like Wall Street adoption. But to the extent that the network continues to be successful, large pools of capital entering it are inevitable. And they do add liquidity to the overall ecosystem and overall market size. They benefit miners, they benefit users. So it is a positive development, in my opinion. But of course, I'd be more bullish to see a thousand different Fedimints pop up, and
Mm,
people around the world, custody it in their countries rather than see these big, honeypots form. But I think
totally.
that, I'd have to agree with that phrase, like everything's good for Bitcoin. I generally would like phrase it a little bit differently, which is most things are good for Bitcoin, and institutional adoption is one of them. So to the extent that there is a spot ETF, I think that'd be beneficial. Right now, you've had all sorts of entities have had to use inferior products. Um, and I think a spot ETF would clean up the market a little bit, at least for American users. Other countries already have, ironically, spot ETFs. It's not really been an issue. So I think we're just seeing another wave of adoption. And I think probably when we look back, 2, 3, 4, 5 years from now, it'll seem obvious. Like, well, of course, there's of course having a Bitcoin in your portfolio as some slice makes sense, even for kind of like normie finance.
What do you think specifically about this ETF? I mean, in Bitcoin, we've been talking about a spot Bitcoin ETF every year. It seems like it's right around the corner. SEC rejects it for one reason or another. But this time it's BlackRock, and so people are excited about it again. But what do you see as the probabilities that they're actually going to allow this thing to go through? And then maybe what are some of the pros and cons of having a spot Bitcoin ETF in your opinion?
Yeah, so I think the next bull market's going to happen regardless of whether or not there's a spot ETF. This kind of thing I think can just influence the timing and the magnitude of it, because it allows potentially new pools of capital to enter that would otherwise, have to enter slower or, in other ways. So in general, I think it would be constructive for price. Um, and As to the odds, I try not to guess these odds. I think we are getting closer. I think that the more iteration you see, especially from these larger entities like BlackRock and Fidelity, it increases the odds, of one eventually being approved, because these filings are not just identical filings from years ago. The SEC always gives their reasons for, why they turn them down. Whether or not they're valid is another story, but they say, okay, here's the reasons why we turned it down. And so then these filings come along and say, okay, we've addressed the reasons that you've turned the other ones down. And then they can say, well, it's still not quite. So they, okay, that's fine. We iterated again. We went and made it even more specific, right? So it's eventually, kind of the SEC gets stuck in a corner where it's like you answered everything they said to do, and they either have to say we don't like Bitcoin, we're not going to approve one, or they just have to, capitulate and start allowing a couple spot Bitcoin ETFs to form. I think one of the funny things is they allowed a leveraged Bitcoin futures ETF, which is clearly a
Yeah.
less safe product than a spot Bitcoin ETF. And so it's really hard to be in that environment where you're just always holding back a spot ETF, but you're willing to do a leveraged futures ETF. Um, as for how it's good or bad, I mean, I think, I would not want to see a particularly large percentage of Bitcoin, uh, held by, BlackRock and Coinbase and, large entities. Um, Generally, the biggest problem that gold faced is because gold was slow. Gold got centralized and abstracted, and allowed for all sorts of claims to be built on top of it. And those claims were not tested very frequently because most people didn't want to withdraw their gold. They liked having access to the liquidity, of a globally interconnected ledger, for lack of a better word. Um, Whereas with Bitcoin, I think the main thing is that it's really easy to test, um, whether or not someone has the Bitcoin they say they do, making sure there's not a lot of IOUs being built on top of it, um, at least relative to the size of the overall market. And so, I think it's better if people self custody or do collaborative custody or do, local custody, like let's say Fedimints, things like that. There's a spectrum that people can do rather than these big giant honeypots of, like one entity holding millions of people's Bitcoin. But I think that at this stage of adoption, people do want to have it in their brokerage account. They want to have a slice of Bitcoin in a diversified portfolio. And I think to the extent that there are a handful of different ETFs out there, that's good for them. If someone would not buy Bitcoin otherwise, or if the majority of their capital is in their 401k or in their IRA, and they want to have some X percent of Bitcoin in there, and that's the majority of their capital, the fact that there's a spot ETF, I think, is a good thing. But in general, it's always going to be an inferior product to the real thing, because the real thing, you can self custody it, you can bring around the entire world with you, you can tip people on Nostr with it, you can do whatever you want to do with it. Whereas when you have it in that ETF form, it's only really good for price. It's more just like strictly an investment, which is a good starting point. But it's just different pools of capital, different products for different pools of capital.
Yeah, and I think we agree. I think we nothing can replace self custody, but different people are going to want different things. But self custody doesn't have counterparty risk, which is a major factor, right? You actually own it, and then if you have an ETF, you also have fees that you're going to have to pay too. So if you own your own Bitcoin, no fees. So I think that's another benefit as well. And I wanted to bring up, you brought up Nostr, and I want to just touch on this because in I think a couple months ago, you wrote a tweet and you were pretty critical of Elon Musk around freedom of speech when he took over the helm of Twitter, and how his actions and his words aren't really matching up in terms of freedom of speech. And just recently, he passed these limits in terms of looking at posts. What is your reaction to that? I would love to hear more about that.
Well, I mean, I think, as long as it's a privately controlled platform, they can do what they want. But when someone's actions and their words don't match up, I think it's fair game to be critical. Um, and so with Twitter under the prior situation had its own challenges. I was not a fan of the censorship they were doing, for example, during the pandemic. Um, and one of the challenges now is that if you look around the world, I think largely it's gotten better in the US, but it's gotten worse in some other countries where Twitter now more readily complies with government takedown requests than they did before. That there's a number of articles out there, from journalists to kind of cover this and quantify some of this. And that's in large part because, when you're Elon, Twitter's small for you relative to Tesla, right? So if your decisions around Twitter would affect your ability to sell Tesla in that country, you're always going to go with Tesla. You're going to make the dictator happy, right? So there's been a more ready compliance with some of these countries than even under prior leadership. So that's number one. And then number two, we had things like, for example, you couldn't even there was that period where you couldn't even like a post retweeting something about Substack. Like you try to like it and it just wouldn't let you. And it's like,
Oh yeah.
really, that's what we're going with right now. Um, and so I think that there's been um, a big gap between perceptions and reality. There's another thing where they talked about getting bots under control, but any large user right now, especially in certain industries, I mean, right now bots are the worst I've seen them. Bots are completely not under control. I think they have to use more proof of work or things like that to try to improve that. I think that the techniques are out there and they work. And so, and this current one, it's rate limiting, right? And some people have theorized that they're having trouble paying their server bills, and other people pointing out, obviously they're being scraped by these other services. Um, I just think Twitter's going through growing pains. They have a smaller staff. I think they're kind of shooting from the hip. So I think that I mean, when they did rate limiting, Nostr had a good day. So a lot of people kind of flooded over there. And that might die down in time if Twitter normalizes for a period of time. But every time you get one of these shocks, people at least want the insurance. They at least want to have a Nostr account. They want to familiarize themselves with it. Maybe they'll use it, maybe they won't. But every one of these is like a marketing event for why you might want open source communications. Similar to how we saw recent news items around a politician in the UK having bank account access shut off. And that's like,
Yeah.
it's like Bitcoin fixes this. It's an advertisement for Bitcoin. So every time either people are shut off from their social networks or shut off from their banking networks, these open alternatives it's a free marketing for them.
Yeah. You're seeing that in France right now. And they kind of limited internet
Yeah.
usage. Yeah, I mean that's basically one big marketing campaign for Nostr. And if anyone's interested in using Nostr, my boy Anil at Anil Said So wrote this great thread about for beginners about Nostr. So go check that out. Shout out to Anil. But Lynn, we are out of time. And I just thank you so much for sharing your knowledge and your wisdom here and taking the time to come on Swan Signal. Where can people find you if they're not already following you, which they absolutely should be? Where can they read more of your work?
So I'm at lynalden.com. I put out free articles, free newsletters, and I'm also on Twitter at Lyn Alden Contact. And they can find me at Nostr as well. I don't have my key memorized, but you can find me on Nostr. Um, and I still try to post there, even during kind of like bear markets and Nostr where there's not a lot going on, and so it's a little quieter than on Twitter. I still try to log in regularly and post there. Because it's something that I want to see become more successful. And I
Mhm.
do like it when the activity goes up on days like, this recent day with Twitter.
Yeah, absolutely. Well, go follow her. And thank you, Lynn, so much. You have a great rest of your day, okay?
Yep, you too.
If you care about your financial future, you need to check out a couple of our offerings, including Swan IRA and Swan Private. Swan Private is our white glove concierge service where you get a trusted partner on your Bitcoin journey. We offer all kinds of education and research projects, as well as exclusive events to our Swan Private customers. Check it out today at swan.com/private. Also, Swan IRA. Swan IRA is the best way to gain exposure to real Bitcoin in a tax advantage account, like a traditional IRA, a Roth IRA, or rolling over your 401k. So if that interests you, check it out at swan.com/IRA today.